9 o'clock. Today is May 9th, 2025. Okay, today is Friday, May 9th, 2025. This is the Governing Board workshop, and I'm going to call this meeting to order, and we'll begin with the Pledge of Allegiance. If you are able to rise, please join me. Thank you. We have a full house up here, so we do have a quorum, and I will read the procedures statement. The Governing Board and its committees conduct all of their meetings in compliance with the Arizona Planned Community Association open meeting laws per ARS 33-1804 and in concert with RCSCW bylaws, policies, and standing rules. Parliamentary procedures, as outlined in the most recent edition of Robert's Rules of Order, will also be followed in all meetings as appropriate, consistent with Bylaw 3.07, entitled Procedures for Owner-Member Meetings, and Standing Rules number 2 and number 3. Then our first order of business is to approve the minutes from April 11th of our workshop on that date. Any changes, additions, deletions? Seeing none, the minutes will be accepted as written. And as we go into our new business, agenda item 3.01 will be a presentation from CapTrust Manager Carol Romney. Director Novella, do you care to say anything?
No, simply to note for our residents that these are presentations that are typically made every quarter at the Budget and Finance Committee meetings. Today, the board president, President Leary, and I both thought that it would be so important to have CapTrust present here to the directors as a whole. We are in some pretty interesting economic times, so we thought that it would benefit all of the directors as well as the community as a whole to hear this quarter's update directly here. So with that, we welcome Carol Romney from CapTrust, who's our relationship manager. She'll walk us through some of the key findings. Thank you.
Good morning. I will review first quarter, so just bear in mind this data is as of the end of March. And in April, we saw a lot of volatility with something called Liberation Day, which we have recovered quite a bit of that volatility, but I just want you to know these numbers are just the end of March leading into that. Most of the portfolio is invested 90% into fixed income. So when we do review the quarter numbers, we do like to just explain what has happened over the course of that quarter, just to explain any performance within the portfolio. What you're looking at here, the diagonal lines are for the quarter, and the solid lines are for all of 2024. So what we're looking at for the quarter is we saw at the end of the quarter leading into April, U.S. stocks were down, and we saw some tailwinds with international stocks. Your portfolio is about 10% stocks, so it did collect a little of that, but it's mostly fixed income, 90% fixed income. And we see U.S. bonds for the quarter were up 2.8%. And because it's mostly fixed income, I do want to just illustrate the drivers to performance in this portfolio. When we look at it in a moment, I just illustrated that the bond aggregate, the benchmark that we compare your 90% of your portfolio to, was up 2.8%. And the drivers to that is mostly, does this have a red button on it? You guys have new equipment here. I'm getting used to it. Oh, look, that's much better than the other little dot. Nice work. I'll just show you right here. When we saw end of the quarter interest rates go down, we see bond prices go up, and that's drove a lot of the performance within the portfolio. The other thing that can affect it is risk in the industry, and that's measured by something called credit spreads, and we just didn't see a whole lot of that yet, although we did see it trick up a little bit. Economic outlook. I wish I had a crystal ball. We're never able to tell you with any precision what's going to happen, but what we can say is stocks have always behaved the way they do, with more uncertainty and higher levels of return over a long course of time. And drivers to stock performance is the economy. Fixed income bonds behave the way they do because they are fixed income. They are more certain than stocks, and the drivers to that will be interest rates and risk within the economy. What we see with an economic outlook here, we see some fiscal policy drag and uncertainty with economic activity, and some waning sentiment. It's hard to tell what's going on with the tariff situation, because we do see a lot of purchases by businesses and consumers trying to get ahead of any increase in prices. So it's hard to flesh out exactly what is the sentiment, how much of this is driven by tariffs, and usually when we see unemployment go up, that's when we're going to see waning sentiment, and we're not seeing too much of that yet. Federal Reserve is still on pause, where the rest of planet Earth, it seems like, is decreasing their interest rates. That's to the char grain of our White House. We're still paused. The Fed will simply look at inflation and unemployment, and they've got a little tricky act right now to navigate. Tailwinds within the economy, still pro-growth policy and initiatives. And also, mentioned a moment ago, we are seeing some favorable consumption outlook. So on to the portfolio. We started the quarter with about 28.7 million, and we had a net investment return of $647,000 and some change, which put us right there at about 29,400,000. Since inception, we are still a positive net investment return. The portfolio is 90% fixed income, and we manage it according to your FY12 policy, which feeds into an investment policy statement, which is our how we manage the portfolio. 90% fixed income, the remaining 10% equity, and we are within those targets. We also have a restriction of 20%. No security can be more than 20% within the portfolio, and we're managing to that as well. And just to compare, we're only, 1 quarter of 4 quarters in 2025, but the portfolio is up 2.25%. That would be that positive net investment return that we saw as of end of March. Slightly underperforming the benchmark, and that will happen, and we warned you earlier, as we navigate the sensitivity of the bonds in the portfolio. Sometimes we'll outperform, sometimes we will underperform, and this is simply driven by interest rates, as I showed you a moment ago, Treasury securities going down, and we are a little bit less sensitive, but moving to more sensitive bonds within the portfolio. So in the short run, completely explainable, and no concerns on our end with this. Questions?
Yes.
Thank you, and thanks for the quick overview. That will hopefully be helpful and lead into some additional questions. We understand that this is a look only through the end of Q1. How are we looking? And again, this is sort of a leading question because I'm already aware. Could you give us a quick understanding of either you or perhaps we have Cliff Swan, our CFO, is with us remotely. Could one of you tell us how we were performing in April, generally speaking?
I'll defer to Carol on that.
Well, April was a rough month for stock, but good for you all. You have a lot of bond in your portfolio, which is great. For April, I wasn't prepared for that question specifically, but if you have the flash report, anybody has that. Unfortunately, I don't have the internet available here, but I did look at the portfolio today with where we're at. So we're just maybe a month. Maybe Pete knows because I wrote him.
I'm the
I write them
Pete
as
Benoit,
synopsis.
the reserve analyst, but I also am a liaison between the CapTrust and the association. As she mentioned, the portfolio of the bonds actually performed quite well. April was in aggregate about 30,000 favorable, but also the yield crossed over 100,000. And so that's a $1.2 million run rate for the annual yield on our $31 million. So through tumultuous times, we held up very well.
Thank you.
Right now, your portfolio is about 28.8 million, and you also have a cash reserve account that we're managing with very little risk, and you're getting about 4 to 5% on that. That's about 2.3 million.
That cash reserve account is what we use for those near-term funds, the things that we'll be using in the next few years, correct?
Director Horvath?
Thank you, President. Yes, one thing that I'm asked a lot is fixed income versus asset preservation. So we have words that say asset preservation. Is that fixed income? And the way we're invested in the bonds, is that asset preservation, or is it fixed income? Or how is
Yes.
that best defined? Thank you very much.
That's a really great question. So when we think of asset preservation, we also need to know time frame, because asset preservation for the long term versus medium term versus short term are different things. If you have cash flow in the very short run, asset preservation means very, very, very low risk. That's that 2.3 million that we have set aside that we could liquidate within a year. And, I'm not worried at all if interest rates go up or down or stock market goes all over the place. That's going to be safe. We're getting a good return on that right now. Preserving for the medium term would mean you can take on a little bit more risk and a little bit more volatility, hopefully collect a little bit more yield over that point in time. And then long term, when you say asset preservation for the long term, you're going to see more volatility within the portfolio. However, you will collect more yield that will keep up with inflation and purchasing power. And that's the key right there for the long term. But if you say asset preservation and we want, to preserve X amount of dollars so we can spend it within 1 year, we're going to put that in very, very low risk investments.
Director Rhodes?
Thank you. When I look at the charts, I think of our very dark days back in 2022 when there was a historic drop in bond returns. And Carol, you've been with us for several years. Actually, I've been involved in this for 4 years, and I think you've been here every presentation that we've had. And when I look at this, I'm really pleased because this validates exactly what you told us to do in 2022. In so many words, it was stay the course. Don't get nervous. It looks bad. It will get better. And those were unrealized losses, which means that it's only a loss if you sell it. And that is not a matter of speak. That's a reality of if we had a $3 million drop, in which we did, if we sold it, we lost $3 million. But at your advice and through the concurrence of the governing board, we decided to steady the course, hold your breath, it's coming back. And today, you're telling us, as I read this, we're back.
Correct.
So you were right.
Yeah, well,
So you can
I
say,
would say
and
you
you can
guys developed a good investment policy statement with us, and we just managed the portfolio according to that, and it works. You know?
and you can say, I told you so.
Well, yeah,
Direct-
2022 was a tough year, and you know, we're just numbers people, probability people, and that's how we build portfolios. We listen to what your objectives are and look at probabilities, and that really was like a once in 100, you know, year type event where both stocks and bonds were both down.
Director Chatton.
Yeah, do we invest in individual T-bills or just in bond funds?
You're invested in bond funds, and that's part of the policy that you have would be to invest into low cost, take cost into consideration. And so we use ETFs and mutual funds, and they have exposure to various types of fixed income securities, including treasuries.
I guess the reason I ask is in 2022, if we had T-bills, we wouldn't have lost a dime. But because they were in funds and interest rates dropped, then we had the unrealized losses. So I'm just curious if in the future, any of our investments will be directly into T-bills instead of bond. Bond funds are always impacted directly by any change in the interest rate. I think lately it probably went down a tenth or two, so geez, we made money, but if it goes, if it goes down, we're gonna be losing a lot. So I'm just curious in the future, we are going to be doing any T-bills.
Not directly, and this is something that has come up over the last couple years over and over, and we've had a lot of conversations. I mean, you can watch previous videos where we've talked about this topic. I mean, it's always easy to look back and say, well, we should have done X, Y, Z, but what we do is we look at your objectives and build a portfolio accordingly. And part of the policy says to be diversified across fixed income. And so we couldn't do an entire portfolio of just T-bills or 2-year treasuries or ladders or something like that. We wouldn't be compliant with the directive.
Director Novella.
Thank you. Just to build on this, I just wanted to, if it helps at all for Director Chatton and anyone else, that near-term fund, I don't know what else to call it. We have two funds that Carol was alluding to, and she's speaking to and walking us through the returns of that $29 million fund, our reserve fund. We do have those near-term cash needs that are met through what you're talking about, cash and cash equivalents. So as we mentioned, and it's great foreshadowing for the next topic that we'll be talking about, but as we currently sit, our investment policy does not specifically call out how to treat those. Our CFO and the team direct the CapTrust to be managing those near-term funds in such a way to minimize our risk, just so you're aware. But so there is a piece of it that is held, but if that helps.
But it would just seem that a portion of not the near term, but the 5 to 10 or 10 to 10 or greater, a portion of that in T-bills would minimize any loss if interest rates were to go up or down.
There is exposure in the $29 million portfolio to Treasury securities as well as corporate securities. So there is exposure there.
Thank you.
Director Horvath.
Yes, thank you. So that leads into what my question was going to be also is the water cooler gang, when they talk about investments, asked me, well, why don't we have a more tiered investment? In other words, something that's rock solid like T-bills, and then something like, say, the bonds we have, and then get a little bit more frisky so that we get a little more return from our $30 million that we have in the reserve fund.
So you, in the $29 million portfolio, there your FY12 policy says to be diversified across investment grade. So it would be treasuries as well as investment grade corporate securities, mortgage-backed securities. So we do have exposure to all of those different asset classes within fixed income that is investment grade. So I would say you do have portions of the portfolio that are frisky. So
Thank you.
you're welcome. And I can show you that on the full deck if you wanted to look at that specifically, or I can just tell you that it's there. At a very low cost too. I think our expense ratio on the entire portfolio, it's in the deck, but I want to say it's like 0.05%, like 5 basis points, incredibly low cost.
Dr. Pyskowski.
Question is, you're our account representative, correct? Is that right?
We're the investment advisor on the portfolio,
Okay, so
yes.
how often does someone from CapTrust look at our account? Weekly, monthly, bi-monthly? How does that work?
So every quarter, we will certainly look at it for sure. And then there's a policy where if we experience a lot of volatility and it goes outside of 5% within certain tolerance bands, then we will rebalance the portfolio.
Dr. Novello.
Not so much a question, but just as well, Carol Romney just referred to this, but for all of us here and for any of our residents here or listening, the attached deck goes into a lot more detail. So for those of you who do have that interest and knowledge, please understand we specifically asked Carol to keep this morning's update pretty brief and high level, but there's a lot of detail that's there for you to look at, for all of us to look at. And that similar level of detail is posted to our website on a monthly basis. So just if you're looking for that kind of information, it's always there for you. If you don't know where to find it on the association's website, feel free to contact any of us and we'll be happy to tell you. Just wanted you to know that there's a lot to dive into, as Carol just alluded to.
And you are always welcome to call me. This is my full-time job, but I adjunct to ASU in the finance department, so I'm also an educator. And I'm very happy to, fill in any gaps of knowledge for anyone if that's helpful. And I also want to say, back to the question about how often do we look at the portfolio, I do send something called a flash report every month to your BNF committee with a narrative of what happened that month.
Okay, thank you. Director Rhodes?
I do have, Carol, I do have a question. It's going to be for you. I don't have any more questions over this, and I think you've done a superb job in presenting this to us. But are you going to be around when we discuss the FY12, specifically the proposed change in ratio? Because I do have questions that
Yes.
I would want to.
I can stay as long as you need me to today.
Thank you. Thank you.
You done?
Cliff, do you have any comments or questions?
No comments or questions. Good job, Carol.
Okay,
Thank you.
thank you. Any questions or comments from the audience? Any questions, comments online?
Nothing online.
Okay, well, thank you. Then we will move on to agenda item 3.02, which is the previously mentioned policy FY12. Director Novello, you want to kick us off?
Will do. Thank you so much, President Leary. We've been on quite a journey. All of our standing committees, one of our primary roles is to review the existing policies that serve our overall association. So as this year's association treasurer and chair of budget and finance, it was my pleasure to organize the committee, and we have a total of 8 residents, including myself, who have served on the committee all year. We convened, or all of our committees convened for the first time officially in September of each working year. But just so you know a little bit about how long a journey this has been, and you can go back to this if you're new to the topic this morning. So we convened in September. The Budget and Finance Committee recommended a deeper dive into this particular policy, which is FY12 and an associated policy FY4, anything pertaining to investments into our reserve fund. So we wanted a deeper dive. We therefore convened what we call a working group with the specific objective of analyzing our investment policies and ensuring that the policies as written still serve the best interests of the association at large. So the working group was recommended in October and started to meet in November. Two very hardworking, we have 7 members of that Budget and Finance Committee, all of whom worked very hard all year together with me. But 2 members joined the working group. That's Rick Rufai and Mickey Jacobs. Mickey took on the role of being our lead for the working group. So she'll be taking the questions and walking us through. But just to give you a little bit more of an insight on the timing. Group got together and started meeting in November of 2024. And you can review the YouTube video on the November 19th Budget and Finance meeting, where we went through the charter, what we were specifically expecting to do. Each Budget and Finance Committee meeting, there was an update on the progress, but the larger one to look for is February 4th of 2025. That's when the working group made a presentation to Budget and Finance, several hours long, but very instructive. We then the working group came here to the governing board at our governing board workshop on February the 14th. Again, a very in-depth presentation on the outcomes of the analysis that for everyone to hear. The board at that point made a recommendation for the Budget and Finance Committee to move forward based on that with revisions to the underlying policy. Since that time, since February, the Budget and Finance Committee and the board itself has really turned most of its attention and time to the formulation of our annual financial plan, the operating budget, as well as the capital budget. But now we are ready to come back to you with the specifics of the policy revisions that we recommend. So with that, I'm going to ask Mickey to step to the microphone. And again, this is Mickey Jacobs, one of our fellow owner members and a member of the Budget and Finance Committee, who's worked very hard on leading us through this. So Mickey, if you can walk us through a little bit of background of the analysis, would be helpful.
I'm a little shorter, so. Good morning. Good morning, directors. I came before you and gave you an overview of the work that we had done. Today, what we're planning on doing is going over the actual red line, the specifics. But before I go through that, I really want to just give you a little recap for you what we did so that we have a nice background before we get into. I think it will make going through the red line a bit easier to understand. So first things, we looked at the current policy, and when we started this year with Budget and Finance, I would say that the interest in reviewing this policy was very high. All 8 of our members were very interested in making sure that this policy really met the needs and objectives of our association. So first, the objectives of the current policy are preservation of capital, liquidity, and rate of return in that order. And it limits equity investments to 10% overall, which we have discussed. Now, we asked ourselves the following questions, one of which has been teed up very nicely, both by Dennis and answered by Carol, is does our, when we look at our cash needs over the short term, the medium term, and the long term, which we've defined as 5 years, 10, less than 5 years, and 10 years. Do our objectives meet what we need in terms of preservation of capital? So, do they support those needs? Second thing is, does our policy help to address our association's development? Our policy currently, we think, supports ongoing maintenance of our facilities, but is there a piece of it that could support the development of our association? And when we look at these, are these the optimal objectives and restrictions? So before we even started, those are the questions that we wanted to answer. So I'm a data-driven person. That is what I look at. I have never looked at a prescriptive approach to investing. In my opinion, and the opinion of many, you have to look at when the cash is needed in order for you to objectively assess what sort of investment is needed. So, as Carol said, if you need it in less than 5 years, it needs to be readily available. It needs to be readily available, liquid, and you can get it without experiencing a gain or a loss. Okay, that's very important. Medium term means you can take on more risk. You don't need it for 5 to 10 years. Medium term risk, as Carol also, and we didn't even have this conversation, she just teed it up for me, is that means you can take on bonds, which bonds are not without risk. You know, people often think, my bond portfolio, but it is not without risk. We have seen that particularly in 22, but bonds are not without risk. If you look over the last 20 years, there have been multiple years where bonds lost money. And the third thing is, if you then look out over 10 years, a 10-year time horizon allows you to be able to weather more volatility. More volatility is appropriate over 10 years, and that indicates that some piece of your portfolio, it is appropriate for you to have it invested in equities. So what we did is, first things first, how much do we need in 5 years? How much do we need in the next 5 to 10? What in the portfolio is over 10 years? So we modeled out a 20-year projection based on the finance team has a reserve study, and they have a 30-year projection of what we are going to need. And we project out both our income, our sources of funds, what we're going to need to spend that has been described in the Capital Reserve Fund, and we also model out some new capital. Then we look at, okay, what might this make in a conservative manner? And then we also looked at it, so we looked at and modeled it out as a baseline over 20 years under the current policy with 10% equity. We looked at a small portion in cash and cash equivalents or treasuries, low risk, and the balance in bonds. So that's our base case. Then we looked at 3 other scenarios. If we increased equity to 20%, 25%, and 30%. We actually looked at significantly other scenarios going up to 60%, but while that might be appropriate for another organization, it might be appropriate for an individual. When we looked at this and our fiduciary responsibility and the board's fiduciary responsibility, we really said that somewhere 10% to 30% would be the sweet spot, and that is something that we wanted to look at. So we modeled that out, and we did it under scenarios that mirrored the last 20 years in the market, both for treasuries, for bonds, and for equities. And so when we looked at those different pieces, we actually modeled it out using historical information. So we came up with that, and then as a check on what we had looked at, we asked CapTrust to do the same for us. They had the 20-year forecast. We asked them to do the same. We didn't give them our forecast, but we asked them to do the same forecast 10, 20, 25, and 30. We wanted to make sure that they didn't come up with something that was vastly different than what we were modeling. What was amazing to us is that they mirrored each other's results. They were not exactly the same, but in terms of order of magnitude, they were within little tiny percents of each other. The other thing that they did for us is that validated that we were using information that gave us a good approximation over 20 years. We can't project exactly what will happen, but we can look at it from what's the probability, right? So when we look at this, and CapTrust does, they actually do these very large simulations that gives you, 1,000 simulations, and this is in the 50th percentile. This is the most likely thing to happen. And when their information came back and mirrored ours, we felt pretty good about that. So and what they also did, which we had not done, is that they looked at the incremental risk of going up from 10 to 20 to 25 to 30%. I'm going to use a little technical term there. That is the, what am I looking for? The
Standard deviation.
Standard deviation. Yeah, standard deviation. So we're looking at the standard deviation, and the standard deviation did not go up very much. When we looked at it and we were able to look at the standard deviation from 10 to 30, we're not taking on a lot of risk as long as it is in the part of the portfolio that is long-term. So that was an interesting conclusion. So it gave us confidence. So when we looked at it and we looked at those 10 years or those 20 years, what we found is that in this period of time, in the 5-year period, what we needed was about $5 million, or excuse me, about $2.5 million in this 5-year period, and about $10 million in the first 10. The $2.3 million is what has been now put into a risk-free piece of the portfolio, and it's invested in treasuries and cash equivalents, things that when you liquidate them, $1 is $1, okay? So what we were able to say, looking at that with confidence, is that of our $20 million portfolio, or $30 million portfolio, 20 of it is not needed for more than 10 years. 2/3 of it is not needed. You might ask yourself, well, we have all of these capital expenditures. How is that even possible? Well, the reason it's possible is that the fund has very good sources of income. The biggest source of income are the APFs. The APFs run about currently just under $6 million a year, okay? Just under $6 million. The fund also receives 7.5% of the association's dues, and that is in the $1 to $1.5 million range, right in there. So that, for the vast majority of the time, those two things cover our capital expenditures. For the next 10 years, they don't quite meet our capital expenditures, and that is because we have these big golf course projects coming over this period of time. Those will be completed by the end of the 10 years. After 10 years, we completely fund our capital expenditures through those two sources of income. Okay? So what this gives me a great deal of confidence is being able to say to you, there's a long-term asset here of $20 million. We're not suggesting that that all be in risky assets, that it be in, but what it really says is that there is an opportunity here to allow our portfolio a bit more flexibility on the equity side, which has fairly significant upside for the association. So where we've landed in the 10, 20, 25%, 30, where we landed is at a 25% equity investment level that we are recommending. At that level, our investment return increased from 3.9% to 5% over the 20 years modeled. Still modest, right? That is still a modest return, 5%. But what that did, that 1.1%, that increased the balance in our reserve fund by $11 million over this period. We went from 58 million to 69 million at the end of this period. That's very significant. It is a more than 20% increase. So that's what we really saw, and that's what we came up with. Now, second, we asked ourselves, so does our policy help support our association's development? Well, currently, so if you look at it currently, where we stand at the 10% is that we will keep up with inflation, but just barely. And I mean just barely. You will not see much of an increase. It will be this fund will basically stay at the 40% fully funded balance for the life of this fund. So what does that mean? It is positioned, that fund is positioned currently to meet our association's scheduled repairs and maintenance, but it doesn't give you any leeway for unexpected issues. It doesn't give you any leeway for projects that you may want to do, that we may be excited to do. It doesn't give us any leeway to do that without special assessments or coming up with the funds in some other way. So when you look at that, and you say, well, okay, what is that? It's at 3.9%. What is that? Why is it better to have some equities in the mix? Why is that better? Well, here's the thing. If we look at it over the last 20 years, and I have, the last 20 years, equities, as measured by the S&P 500, have averaged 12% over the last 20 years through last year, 24. Bond returns, and this is based on the Bloomberg Total Bond Index, have averaged about 3%, 3.1%. Treasuries, 1.6%. So your no risk over 20 years has been 1.6%. And although we think of bonds, as I said, as being risk-free, as Carol said, when you look at 22, so in 22, bonds lost 13%. Equities lost 18 or 19. But guess what happened on the recovery side? The next 2 years, equities increased 22% and 24%. Bonds did not recover. Bonds didn't go up by that 13%. Now, what I will say is CapTrust has done a great job, because if you just look at what overall bonds have done, they haven't recovered, but they have recovered in this portfolio. So kudos to you. But here is the interesting thing. The interesting thing is that when we look back 100 years, okay, which I've done. I've looked back 100 years and looked at successive 20-year periods and compared successive 20-year periods, equities to bonds. In that 80, and that comes up with, starting in 1945, those 80 20-year successive periods, bonds have outperformed stocks 3 times. Twice in 18 and 19 by less than 0.25%, 0.05 and 0.25. And once in 1948 less than 2%. The rest of the time, over those 80 periods, stocks outperform bonds by 4.8%. This is the argument for having in a stable, long-term piece of your portfolio. This is the argument for having more equity exposure. So, our current strategy, so are these the optimal objectives and restrictions? When we looked at it, we said we find these restrictions to be unnecessarily restrictive. They don't match, nor were they even considered. They don't match our 5 short-term, medium-term, and long-term cash needs. Frankly, those periods of time were not even addressed in the policy, right? So they were not even, so what we are saying, more equity exposure is appropriate for long-term investments. And there is a risk here. There is a risk to staying with the current investment policy. There's the risk of the erosion of your invested asset values in terms of inflation and purchasing powers, and the inability to afford to make new investments without member assessments or increases in dues, as I said. And then finally, if you look at our mission statement and our organizational values, and I like to tie things back to both of those things. Our mission statement says, enhance members' quality of life by offering outstanding facilities, services, and enriching social and cultural experiences while ensuring financial sustainability and operational excellence through continuous improvement. That's what I think this is. This is part of financial sustainability and continuous improvement. When you know better, you do better. And our organizational values, community-centered, integrity, excellence, innovation, and stewardship. This hits on stewardship. Stewarding our ability to continue to maintain the quality and the quality and character of our assets, which our assets are, our assets in the reserve study are about $115 million. It is a big, we have a big operation here. This allows us to be good stewards of our assets. Okay, so that's the background. So what we should do now, so we are recommending the outline, an investment strategy with a range of 15 to 30%, 35%, 10% less than 25, 10% more than 25, with a target of 25% equity. As we said, we actually are going to put in the policy the preservation of capital has a timing component. And so we have outlined appropriate investments for money we'll need in less than 5 years, medium term, so that's less than 10, and long term over 10. On the short end, which may surprise you, on the short end, this is actually more conservative than the policy that we currently have. The current policy says that operating capital in the budgeting, in the operating fund, must be invested in treasuries and cash equivalents. Doesn't say anything about that first 5 years. So we have incorporated that and actually carved that out, that if we need it in the investment fund, in the reserve fund, in a 5-year period, it's in no risk, the no risk category. And we're recommending a range rather than a single target. So yeah, let's go back. I'll go over this in a minute. Well, let's go back to the beginning, and I'm just laying it out for you right now. The reason that we're recommending a range rather than a target is this. A single target gives you no flexibility. If something happens, you need to respond quickly. And so in both, if in a volatile market, it doesn't give you any time to wait it out for a little bit. What this really allows is that both in times, it allows CapTrust to have a scheduled time frame that they are going to rebalance the portfolio, and not really worry about, am I above or below? It will all be rebalanced back to the target, but it gives us some leeway, and it allows us not to be reactionary to sudden moves in the market. And it allows us to really leverage the expertise of our investment managers to provide a better return on our investments. So that is my overview. So now we will go through the actual red line. So one of our things with this red line is that what we were trying to do is not make too many changes. It's going to ended up being more changes than we sort of expected to begin with. One of the reasons is that our current policy wasn't numbered correctly. And so a bunch of the red is because we numbered it to match other parts of policy. So one of the things that we did add here, and this is kind of setting the tone. We actually can't put in policy, you must maintain a consistent strategy. That's impossible. We can't do that. However, I will tell you from an investment strategy, staying invested consistently is the key to optimal results. Most of us have seen that. The key to being invested is being invested every single day, because I don't know about you, but I can't time the market. I do not have the ability to sell at the top and buy at the bottom. So the strategy is to stay invested within the structure of our policy. So what we've added here is to say we want a lasting, conservative, and prudent approach, one that has an overall mindset of maintaining a consistent strategy. And that's what that is designed to point at. So we can now go. Thanks. All right, so investment of funds. So first we lay out the cash flow requirements, which we just talked about, and we defined operating. So we have operating funds, and then we have net short-term capital expenditures, which are reserve funds for net capital expenditures projected to occur in less than 5 years, offset by projected inflows as set forth in the annual financial plan described in FY15. So we're going to use our own tools to determine what that net short-term capital expenditure is going to be. Medium-term, and it's the same for the others, medium-term capital expenditures, reserve funds for capital expenditures expected to occur in more than 5 years, but less than 10 years, and then finally, long-term capital expenditures expected to occur in 10 or more years. And these are all net. What that means is net of the inflows. So 3.2, here's where we begin to say what we're going to use for each one of those 4 categories. So operating funds for day-to-day operations may only be invested in cash equivalents and short-term U.S. Treasury and federal agency obligations. And examples of items commonly considered to be cash equivalents are Treasury bills, commercial paper, and money market funds. So for both, and we put it in for both our operating funds and our projected net short-term capital expenditures. So if we go up, those are exactly the same. Then we go to reserve funds for medium and long-term capital expenditures, may be invested based on projected medium and long-term annual liquidity needs using the following instruments. So to Director Chatham's point, we allow in all of these buckets, we allow cash equivalents and short-term treasuries. There is no prescription against using them in any of the buckets. All we say is that really short term, that's all you can use. But then we also allow open mutual funds or exchange traded funds that trade in one, bonds. These are appropriate for both medium-term and long-term liquidity needs, and domestic and international stocks. These are appropriate for long-term liquidity needs. Then we did not make any changes to 20%. You know, we can't have more than 20% of any investment in the portfolio. And then we talk about the variety of fixed income and equities as described above, with a target of 20% and the range of not less than 15 and not more than 35%.
The target is 25,
Oh, I'm
correct?
sorry, excuse me, 25%. And the balance will be fixed income investments. That is it. That is it. So, Christine, would you like to?
Yeah, just to recap, and again, thank you so much, Mickey, for the recap of the essence. I just wanted to underscore a couple of key things. Number one, we are actually more conservative in this policy for our near term. It addresses one of the critical components that Director Chatton and others have alluded to. What do we want to ensure our policy reflects the good practices that our operating team and staff have really already, they're endeavoring to do this, but we really felt it was important to put into policy the fact that those funds should be at a minimum risk, absolutely minimum. So this policy actually injects more conservatism on one end, right?
Yep.
So please bear, and I believe all the directors will recall that. We just wanted to call out why it's there. The other component is that we have addressed some of what actually Director Horvath, I believe, was one of those who mentioned, gee, why don't we actually specify different approaches for different phases of our funds? So this, again, the working group and the Budget and Finance Committee worked very hard under the direction from me specifically to keep the changes to this policy minimal, meaning the red lines, so that we could all focus on the essence of the changes. But we felt that it was really important to take the time to spell out those 3 different areas and a different sort of approach for each. Lastly, the working group felt it was very important to give specific instruction or guidance for all of us so that we understand what the term cash and cash equivalents meant.
Correct.
And Mickey, would you please speak to why the working group felt it was suitable to strike the words backed by the full faith and credit of the U.S. government?
Because there is no treasury that isn't backed by the full faith and credit of, right? There is no, it is an unnecessary addition. That's what treasuries are.
That's the only reason why
That's
those words
the only
were
reason.
stricken.
Yes.
Okay, Director Horvath.
As usual, that was beautiful. Very nice presentation. I'd like to point out one other thing, and that is that if we were to just stay at 90-10, there is a cost to stay there because CapTrust has to level the playing field each time we go over 10%, right, to get us back to 10%. So there has to be a cost there too, correct? Am I correct?
There could be some costs, if I may jump in, to rebalancing a portfolio. I think we will see that too. It doesn't always mean there is, but there could be some. That's true?
Correct. And I'm going to say, Director Horvath, at the level that it's at right now, that's probably a minimal cost. However, when I was watching one of the presentations, we were a tiny little bit over the 10%, and that was called out. And I think that's just unnecessary to have to call that out. It is, what we're really looking at is you're trying to make this a policy that is implementable, that works for you in all situations. And so I would say, if the decision were made to stay with the 10%, I would still add a range, personally.
Okay, Director Rhodes.
Thank you. Mickey, that was an excellent presentation. I've heard you before, and you always make things seem much more simple than they really are. So, but it was seamless. There's two things in this presentation that I took away from it. One of which, and I know that Dennis will be very interested in, is preservation of capital. And the other is, does the policy support the organization's development? Those are the two drivers behind everything we do here. Christine Novello and I have had multiple discussions regarding this 1090 ratio. As a matter of fact, I think it was when I very first interviewed you back in 2022, and we both looked at it and said, are you kidding? You know, because a 10%, this is the equivalent of burying your money in the backyard at 10%. I mean, to me, it just doesn't make any sense whatsoever. Whatever I say here is not considered to be critical, but the only concern I have, and I fully support the changing our ratio a minimum to 25%, and that's basically what you're saying, is I'm nervous with the range. And I guess that's where I'd like to talk to Carol about that. Say that the range will be, the target's 25, and we'll let CapTrust decide how far on either side we're going to go. Because what we're doing is we're not forfeiting, we're permitting a wider range of autonomy with the investment firm than we have in the past. So this is going from, right now we're at 1090, and the proposal will put us at 1585 to 3565. So that's a huge range in there. And quite frankly, I'm nervous about that. Carol, can you help me with that, understand that better? Yes. Or give me a higher sense of confidence that
a range is important, and let me just run a scenario for you. Right now, your portfolio is $31 million. If we include that, $2.3 million, that's going to be spent very soon. That's going to go away, which means that the value of your portfolio is going to go down. When we're talking about 25%, we're talking about 25% of the entire portfolio. When we spend money, and there's some big chunks of money coming out, within the next 10 years, when those monies come out, the equity portion of the portfolio is going to be larger, just because you're going to take money out. So that slice of the pie is going to be a bigger piece of the pie. So we need those ranges just so we can stay compliant. And then we do, rebalance the portfolio. Lots to unpack as you all were talking. Mickey's numbers are very, very good. She knows what she's doing. I can attest to that for sure. But the cost of rebalancing, you don't have to pay taxes, so that's good. There are some, maybe minimal trading costs there. There aren't much, but when we have the 90-10 right now, we mostly rebalance the portfolio with just cash coming in. So, you're earning 4, 5, 6%, depending on the type of fixed income, and there's some dividends. So we get cash every month and every quarter on the portfolio, and we use that to just buy those, items that are lower within the portfolio and rebalance it to the 90-10. So we're usually not selling very much. We're just adding to the portfolio to get it back to the 90-10.
So one follow-up on that, if we give you the green light on this, if the governing board passes this, you're gonna have to move from 10 to 25%. Well, actually, you could move from 10 to 15, because that would give you still an acceptable range, but your target's going to be 25. So there would be a minimum of a 5% that you're going to have to change right away, and there could be an opportunity loss there with selling products to get to that 15%. Would you do that? Let's say you do it on the 15th or something, or a given date, as opposed to, well, let's play with it for about a month or 2 months or so until we make that, so we can minimize the loss that we're going to have, if there would be a loss.
In a portfolio, there's always going to be things that are up and things that are down, just depending on the time frame that you're looking at. Hopefully over a long period of time, everything's up, as we see with your net investment return right now, and just our short, 3 or 4 years we've been together. When you say go, when you say this is our mandate now, we want 25% equities, we're going to look at, okay, what is the cash need that you have coming up? Because I think there is, recalling from the spreadsheet, there is a pretty large cash need maybe coming up next year or so. And so we're going to look at that and maybe set that aside before we put, a full 25% in. But we'll stay within those ranges. Academic research shows that you can just rebalance it, at one time. You can just go ahead and implement the policy right away. You can also, we can put just something in where, okay, we're gonna get to this target over the next 3 months by implementing 5% per month, just some sort of systematic process. Either one is fine.
Well, I think that the whole concept of going to a 25% equity is well advised. I think it's something we would do. And in this policy, we could actually go to a 35% equity.
If I just frame this, if we look at 31 million, take out, a couple million there that's going to be spent. Let's say you have 29 million. 15% to 35% is 4 million to 10 million. Great financial crisis, we saw equities go down 50%. In 2022, we saw them go down, did you say 18 there? Yeah, 18%. But the flip side is when markets go down, these securities are producing dividends. You are buying low. This is how you build wealth. You don't need those dollars for 10 years. I mean, I like it when markets go down because I can put money in, and pick up more market share when it's down. And I think Mickey had said there was maybe 20 million of your portfolio that you don't need for long term. So when we're talking about 15 to 35%, that's, the numbers $4 to $10 million there. And then, that's just what's going to have the most volatility.
I think my final comments are, if I could, Jack, and then I'll turn the floor over, is when we look at preservation of capital. And I believe that there's one more element to preservation of capital, and that is the preservation of capital over time. So if we had $100 today, and our charge is preservation of capital, if you ask me in 5 years, do we still have that $100? I would say absolutely, but that $100 is only worth $75. So we didn't preserve the capital. So we should have invested it. And so preservation of capital includes investing, and anytime you invest, there is a given risk. So we all know that. So that's it. Thank you.
Okay, thank you. Director Pieskoski.
I believe in one of the BNFs that you guys talked about how we would go from 10% to that, and that they wouldn't just click it and do it. They would do it gradually when they have that money to do all that.
That was, thank you, Director Pieskoski, if I may President Leary. That was why I had my hand up, just to put a finer point on or to start to address some of the questions around implementation. Remember, governing board, we set policy, we talk about what is important. How it will be done is really in the hands of our staff, but we've all discussed at length our implementation opportunities, right? And Carol, if I believe, just to recap what you've told us before and what you just mentioned, there are two broad options that will be available. One would be to make those changes all at one time, at a time to be dictated, if you will, directed through our staff. And the other would be to direct the CapTrust to start to move some of these funds over a period of time, such as a fiscal year or what have you. I believe those are our two options, and assuming the governing board decides this is in our best interest and we do want to implement, we would then start discussing implementation. We talked about it in BNF, right?
Yeah, that's correct. We stay pretty systematic. What we don't do is try and bet, what's going to happen next month and should we invest now or wait a month. We don't do that.
Okay. Director Horvath.
Thank you. Just to follow up, is that something that you would expect us to tell you how to do it, or would you recommend that we just approve the range, for example, and say, get this done in the best interest CapTrust?
If you blessed this today and gave it to us today, we would update our investment policy statement, which is basically our manual for operating the funds, which goes into, there actually is a range right now in our investment policy statement, which is 5% on each side. And so we would update that and implement it unless you said, hey, can you please, stair step us into it?
Okay, yeah. Pete?
Thank you. I attended the meetings that, the working group. To give you some comfort, everybody seems to presume that all of our bond holdings are underwater. Oh my God, we got to recognize a loss. But I anticipated this question coming up, and one of our holdings is of almost $2 million is favorable valuation right now against the cost basis. It's not going to take I think you referenced $4 million to reach the 25% range, somewhere in that range. So you would have essentially, a liquidation of that to put into the equities almost pain-free. So I don't think you'd have to have some negative impact to make that happen.
Thank you. Any other questions or comments from the board? You do have one more, okay?
Just so the governing board is aware, and our owner members as well, we have, Mickey alluded to the fact that we worked very hard to minimize a level of change. You'll see that if you look at the entire document, there are both items that are highlighted in yellow and red, bold, and so forth. Some of those are renumbering, but the key changes are all highlighted. There are a few blue highlights as well. That's just to differentiate and to call out the fact that with any of our policies, we have the option to do this. This is such an important policy that we as a board decided to have legal counsel review this to ensure that we are in compliance with any requisite laws and with our own articles of incorporation, et cetera. So the blue highlights were a few of the changes that came back from our legal counsel. There's no other difference other than those things. Just if you're wondering what the color coding is, they're all change, but the blue specifically came back from legal. That's it.
Okay, thank you. Any questions or comments from the audience? Any questions, comments online?
Nothing online.
Nothing online. Well, do you have a comment or a question on this?
I do have just one comment. I fully support this new policy. It's been a long time coming, and I think that the committee has done an incredible job on this. The only change that I would make is on 2.0 when they talk about the purpose. And The policy is subject to periodic review by the treasurer and chief financial officer. Excuse me, and I would add, and the RCSCW board. I mean, I think the board should be part of that periodic review. Only comment. Thank you.
That would happen in any event if we're going to change a policy, so we don't need to state that in the policy.
And if I may, if you read the entire sentence, it's an investment strategy. So the purpose of the policy is to establish an investment strategy subject to periodic review. But I hear what you're saying, Director Chatton, and just wanted to assure us that the policy, absolutely, that's the board. The investment strategy is periodically reviewed together with CFO and treasurer.
Was it Director Pyskowski? Did you have? Okay, go
Oh,
ahead.
I just have one comment that I wanted to make on the range. So on the range, the range that we came up with, to tell you the truth, is not that 15 to 35% is acceptable. The target is 25%. And the target can be changed, right? But it would have to be changed by policy. The target is really to give you flexibility. And what that may mean, as Carol pointed out, is that in times that you need to take money out, it means that you don't have to liquidate right away, especially because we have APF funds coming in. You may have cash coming in later, and that will then rebalance you. So it is simply to give you flexibility. The target is what we're really, plus or minus a few percentage points. That's what we're really, if we want it to be other than 25, then we should reset the target and reset the range. But the range is to give you flexibility, the ability to move things around without precipitous issues. But the target is what we are really looking at for a long range investment.
Is it fair to say that the range would allow us to optimize any rebalancing that needs to happen?
Yes.
As opposed to just knee-jerk reaction?
Yes.
Director Pyskowski, did you have a?
Okay, so under the 3.0, the investment funds, we have short-term, medium-term, and long-term. I get the definition and everything, except for who determines how much is long-term out of our $30 million? Don't you think we should have percentages there?
No, because it actually changes. It changes. It is based on, so here's the thing, is that it is based on the 30-year study, right, that is done. So that 30-year study shows every time it's updated what that amount is. It tells you what's needed in 5 years, what's needed in 10 years. Anything over 10 is included. What I'll tell you, if we were saying that we were going to invest everything over 20 years in equities, then we'd have to be very prescriptive on that. That's about 65%. We're not saying have 65%. What we're saying is that the maximum you can have in, the target is 25%, everything else. So you actually don't have to, it is in that reserve plan, but we don't have to, we're not investing the whole piece in equities.
So our R&R basically tells us that? Is that what you're saying?
It's the reserve study.
The reserve study tells us
reserve
how much
study.
will be going into the medium, long,
Correct.
and short term.
Correct.
Okay, just
Yeah,
making,
yes,
because
and we pointed out, right, it is as put together by our finance team, by our CFO, right? That is who is in charge of that. So that's where we came up with the 2.3 million. And frankly, putting that to me, that was a big, important change. Before, we could have had our money in longer term bonds and had to liquidate it at a loss, right, during this very volatile period. So the fact that we've taken our 5-year money and put it in basically no risk amounts, That's a key change to this policy. So the 5-year is very important. Anything over 5 years basically can be invested in both bonds and equities with a limit of 25% of the total as a target. All we did with looking at the 10-year was make sure that the 10-year is more than 25%, and it is. The 10-year is closer to 65%.
Director Rhodes.
I hate to keep pounding on this. The part that I'm still nervous about is the range.
Yep.
I fully accept 25%. I would probably have accepted 30, but I accept 25%. I'm nervous about a $6 million range, because if we have $30 million and 10% on either side of 25% is, you know, there's the $6 million. That's a pretty big target. That's way, to me, that's way too big. Right now, we're at $0.
Yeah.
And we're going to move to a 30 million, or we're going to move to a $6 million target. I would be more comfortable. Now, first of all, I have an explicit trust in CapTrust. You know, they know our products, they know us, and I'm positive that they would do the right thing. Someday, Carol may not be sitting in that chair, and we might have another company, and we're going to have a different governing board, and they're going to have different views on this. I'm afraid of that 10%, 20% range. So just to be prescriptive, which I hate to say that, I would recommend that we change that to 5% on each side. And again, I think it's not necessarily that I distrust anyone. It's just that I think it gives us a tighter range, and it gives us more, it would give me more confidence in that we've done our diligence and we're not just going off on this on a, you know, over the top.
So I understand what you're saying, absolutely. And I am going to let Carol address that. I personally am not uncomfortable with the 10%, but I understand being uncomfortable with it. And so I'm going to let Carol kind of address the operational issues with that.
This is your policy, so we will do whatever you want. The tighter the range, the more restrictive it is for us. The wider the range, the more flexibility we have, especially with cash flows when you have big chunky needs that come out. You know, it may force us to have to rebalance at a time that may not be favorable. So the wider the range just gives us more flexibility. If we have a target of 25%, you know, we have several managed portfolios, and we also do private wealth. We're at one of the larger RIAs in town, over $5 billion in assets that we oversee. So we are professionals at this job, and if we have a 25% target, that's where we're going to stay. And my hope is that range of 6 million, you know, stock over time grows more than bonds. So my hope is that it's getting too big and we have to keep selling to rebalance it down, you know, and not the other way around.
Are you finished? Okay.
Director Leary?
Yes, go ahead, Cliff.
Yeah, I'm struggling to understand what the fear is of having the range. You keep saying there's a fear there, but what's the fear? What are you worried about?
Cliff, I don't know. I don't like the idea of right now we're at $0, which I think everybody in the room agrees that's wrong.
Actually, that's not true.
Well, there is a slight variation there, you know, but it's not going to be, it might be $500,000, just guessing, you know, but.
I believe Carol stated that it's a 5% range that's acceptable in the investment strategy, not our policy. We're specifying here a range.
Correct, but it isn't in the policy. And
It is not currently in the
It is
policy.
not in
It's
the
in the
policy, right.
strategy
And
that
so, yeah,
that
and
our operations team has established.
Yeah,
So
but what
just
I
so you're
would-
aware.
yeah,
Sorry,
but-
Dick.
What I would say is that if we're going to have a range, it should be in the policy.
So is-
That's all I wanted to add, Director
I
Rhodes.
guess
Sorry.
the question I have is, I almost hate to ask it, but what's an acceptable range for funds such as ours? I'm not comfortable with risking with a range that's that large. Because you say 10%, it's not 10%, it's 20%, because it's 10% on each side of 25%. And that's huge, that's $6 million.
So, I want to make one comment on that, right? So if we have a year, and we do have, we have years coming up where we are going to be removing, we're going to be funding the golf course irrigation projects. And those can be, I think we have a year that one of the projects, Cliff, what's the biggest project that we're going to have?
It'll be
Not-
Pebblebrook
Yeah.
Golf Course. It'll
8.5.
probably, around 8 million.
Okay, so if you had to take that out at one time, 25% of that is $2 million. So your 5% doesn't hit $2 million. And that's what I am a bit concerned about, is that in a year where you have a big capital outlay, and perhaps it all has to come at a, pretty close to the same time, and it's going to be within a year. That's what I'm concerned about. So maybe you could, honestly, and maybe this seems silly, maybe you can split it. If I think I have to tell you, I think 5% is too low. I really do. 5% at basically $1.5 million. That is a change that can happen very precipitously. So, and if you think about the range is $6 million, but at one point in time, it's never $6 million. It is either on the high side or the low side. So the range of the difference is $3 million.
Cliff, did we get an answer to your question?
No, I still don't understand, because if Director Rhodes is willing to make it 30%, then what's the fear of the range? I don't understand. I still don't understand what the fear is. If they're operating within the range to optimize rebalancing and to optimize big capital purchases with the objective of getting back to the target at 25%, which will be in the IPS and in the policy, I still don't understand what the fear is.
Cliff, this is Tim Hurley. I think part of the fear on my part is that from our member standpoint, we're going from 10% equities out to a maximum of 35%. I mean, and people who get their information around the golf course or on social media, that's going to shock some people. And that's one of the things that I think about. The other thing too is I'm not really confident that I want to vote on this my last month on the job.
Well, I understand that fear for sure.
I can appreciate as well, although I still have a year and a month to serve on the governing board. I just want to again remind all of us who are listening that it took us about 8 months of work to get here. If we defer a decision like this to the next governing board, we will be here with that governing board in May of 2026 having the same conversation. It's just the nature of our cyclical beast. So just to, if there are any concerns from our owner members about who is voting on this and the timing, it just takes a long time to do proper analysis, and that's what we illustrated when I began. So that's the first thing. I do understand where some of the concerns are coming from, just to sort of underlay again, with some of the huge, looking at our next agenda point and so forth in terms of our upcoming expenditures that are forecasted in future years, we have some very large capital needs that are coming up. And again, just to underscore the potential impact, the way that I look at it, and perhaps again, it's just the way that I'm looking at it, one director, one individual, I see this range as actually giving us a lower risk, if you will. Bear with me on that. It's a lower risk because the risk here is that in order to come up with the liquidity for those very large expenditures, we may have to liquidate at an inopportune time. Giving us a larger risk, a larger range means we can make those reductions and minimize any impact. Let's hope there are none, but that's how I see it.
Director Horvath.
Yes, just a sort of a follow-up comment here. Like Carol started off saying she doesn't have a crystal ball, but none of us do, and we certainly can't look that far ahead in the future to see what other boards are going to do, what the economy, whatever is going to happen. I look at it at 70, almost 76 years old. You know, if I'm going to go to a doctor, then I'm going to listen to what the doctor has to say or find a different doctor. In this case, the doctor is CapTrust. So I think that it's very important that we listen to CapTrust. We tell them where we're comfortable, and I agree with what you're saying. I can see what you're saying, but let's trust CapTrust. Thank you.
And to build on that, the other part of it too is remember that this working group are our members. They live here. So, and they are the experts on this. They have the experience that most of us don't have. And same comments as Dennis, but for that working group. Yes, Director Rhodes.
So just for a sense of confidence, this is not a deal breaker for me. I'm not going to be an obstructionist with this. I strongly believe that we need to change our investment portfolio. Strongly believe that. And we've had some very learned people in the past few minutes, Carol and Mickey and Christine and Cliff, and they've all assured me that it's okay. I wish I had that assurance inside of me, but this, to me, it's not a deal breaker. I would like to see it narrowed. I'm not going to argue about it. I will accept the 10%. Somebody will probably come back in a year to say, I told you it was going to be okay. And that's okay. That's okay. So just to give you a sense of confidence, I'll be good with it because I believe the people in this room who have expressed their positions on this, and I'll be convinced of that.
Thank you. And I think another thing to keep in mind is that, remember, there is a target, and the range allows our CFO and our staff, and as well as CapTrust, to have that flexibility, not to leave it out there, but to time it and to bring it back to that 25%. So I look at that range as being, yes, maybe it is it's a wider than what we might be comfortable with. Some of us might be comfortable with, but it's exactly, I heard the word short term. It's something that will exist only for a short period of time to bring us back to the target. Okay,
yeah, because I haven't spoken enough. Joking. One of the other things I just wanted to say, putting aside the question of the range, there's so many improvements. And again, first of all, I want to say that the policy itself was well written to begin with. Kudos to all the past governing boards, et cetera. There wasn't anything structurally wrong, right? I just want to make sure I preface my statement with that. But there are so many improvements, and that's what happens. You see something, you find another way. There's so many improvements in this policy. One is we're reducing the risk for those short-term funds, right? That's a very important thing for all of us, and it puts into policy the good practices of our current operations team. So hats off to them for that. The other thing this does is actually isolates to a degree or gives us more structure on what those definitions are. We do have our financial plan, our 5-year plan that's specified every year, approved by this board. So this gives us structure around what's the amount and visibility. So there are lots of improvements that I believe we've built in here. And yes, I know that we do have some great debate here on, and I love that we have debate on the size of the range, but actually putting into policy the range is a critical point for me as well. I'm less concerned, believe it or not, with the amount of the range than I am about putting that into policy. I think that it's important for us to have that visibility. I wasn't aware until we started working on this with CapTrust that the strategy that they employ does have a range. So I'm glad that we're putting that into policy. Just a few other improvements. Thank you.
Director Horvath.
Yes, just one more comment. I totally understand what Director Hurley was saying. Actually, I was at the BNF earlier on Tuesday and was joking with Mickey that if we do some of this stuff, maybe it would be nice if she would write a letter in the newsletter, explaining the steps. She does it so very well that could eliminate some of the water cooler objections. Thank you.
Thank you. Yes, Director Piaskowski.
Okay, I know this is kind of nitpicking, but 3.1.2 says, as set forth in the annual financial plan described in FY15. If people read that, they might think it's only applied to the short term. So maybe we want to throw that up as after by cash flow requirements as set forth in the annual plan.
Yeah, I think that.
Do you see what I'm saying?
I do. I think that is, that is not a bad idea, right? So that might make it more clear, right?
Well, they might read it and they say, oh, so short term only has that. What happens to medium and long term?
No,
but if we put it in the front, then it says all of them are going to take care of it.
And that is, I think that's I just think it's an interesting point that this is all based on our own financial projections. That is what we're looking at.
The only thing that I must add, though, is that medium term and long term are really more built around our reserve study. So it's not the same.
The financial plan includes the.
It does include the long.
The long, yeah, the financial plan, what is shown is the 5 years, okay? So what is shown in the 5 years, but that's just the first 5 years of the 30-year plan. So the plan includes the whole thing. Yeah, the plan includes the whole thing.
So Director Piaskowski, what verbiage are you suggesting and where should it go?
Just investments of funds shall be guided by cash flow requirements as set forth in the annual financial plan described in FY1 as follows. And then you can, 3.0 investments, right?
I believe you're saying, Director Piaskowski, that final comma, as set forth in the annual financial plan, that we would move that phrase up to
Correct.
3.1.
Up to 3.1.
Yes.
Is that acceptable?
I think that's a good
Good catch.
change. Yep, I think that's a good change.
I think it's much clearer.
Makes it more clear.
Okay.
Agreed.
Agreed? Okay.
Can you read that to me?
Yes, so 3.1 will say, guys, keep me honest here, investment of funds shall be guided by cash flow requirements as set forth in the annual financial plan described in FY15 as follows. And then strike it from 3.1.2. Okay, good. Okay, any other discussion from the board? Yeah, does everybody agree to that? Does anybody not agree to that? Let's put it that way. Okay, I see no objection, so everybody, the board has agreed to that.
So the committee can very quickly redraft this and repost it for review should we decide to move forward. This will be available for us to vote on as needed.
Okay. Well, so that's my next. So any further questions from the audience? Comments? Anything online?
Nothing online.
Okay, so then I want to get a consensus to move this policy as amended to our regular meeting to vote on. Can I get a consensus to do that? I see head shaking, so we will move it to the regular meeting. Thank you, Mickey.
I just want to say thank you very much for giving me the opportunity to do this. This was it was a fun and interesting, and it was fun and interesting, and I also feel like we made a big difference. So we appreciate it.
And I think we would all agree. Thank you to you and to Rick, for both of you for doing that. Okay, playing with a grenade. Thank you, Carol. Okay, that concludes 3.02. 3.03, the proposed FY25-26 financial plan discussion as needed. Is there any discussion? Cliff, do you want to say anything?
The only thing I'll say to open this up is that we made a change in the capital spend to exclude the 300,000 for the website redesign, and that impacted our reserve study and our reserve fund when we did that. And those changes are reflected in the budget packet that's attached to this agenda. Other than that, there are no changes.
Okay, any questions for Cliff? Okay, Director Chapman.
Just one. I think I've mentioned this to you before, Cliff, but we have the wage increases are based on 4%, but some of that is performance-based and some of it's required by law if the minimum wage goes up 3.4%. What we don't know is what the COLA is anticipated to be. I would assume that anyone who has had a adequate performance rating would receive as, at a minimum, a cost of living increase. And as Tim would say on the golf course, people are going to say, oh, everyone's getting a 4% increase. It's not true. Some will just get a cost of living increase. I think that should be stated somewhere. And I know you won't know for sure the exact number till the end of the year, but there has to be a reasonable estimate of cost of living that came into as a factor in arriving at that 4%. So.
Yeah, so the budget of 4% is to cover both. So
Yeah.
again, we don't have a calculation we can cite because we don't know what that is going to be. It also, the Arizona minimum wage is also tied to COLA. So we have that estimated at 50 cents for our positions that are tied to minimum wage directly as an increase for them. So unfortunately, it's putting the budget together in February and not knowing what the minimum wage increase for the following year is going to be. That's just unfortunately how we have to estimate that. I will say that the 4% is will cover the minimum wage and give us an opportunity to merit increase the employees who deserve to be merit increased, along with taking care of the positions that we have to fill and go to market for or reevaluate and get on the market for. So I wish I had an exact, detailed calculation for you that I could give you, but we just don't have the data to do that.
I wasn't, excuse me, I wasn't looking at an exact calculation, but you had to have some idea when you arrived at 4%. Because given what the estimates are currently, the only thing we could say about COLA is it'll be less than 4%, unless the budget is changed at some point in the future. So I'm just curious what the estimate for COLA was going to be. I think as directors, when we deal with the public, and we don't want to look at we don't want to be saying 4% when we know for a fact it won't be 4% unless it's part of that is a performance increase.
That's correct. So we're not tied directly to COLA. We have built in the budget to be able to address cost of living increases, inflation, things that impact our employees, as they do everybody in their pay, increases in insurance premiums, all of that. So it's not an exact calculation, and it's not, we don't say it's COLA per se, it's a cost of living increase, and then the ability to, merit those who deserve so. So it's, again, it's just not an exact calculation. I don't pull a number from the Fed and say, okay, there's my baseline for what everybody gets, and now we're going to do an increase on top of that for everybody, and it's fixed. It just doesn't work that way in our budget.
Excuse me. If I could add a little more too, if you recall, in the strategic plan that was approved by the governing board is a directive for us to conduct a compensation study and look at our different positions. Obviously, to accomplish that, and we already know that we're behind in compensation, but in order to accomplish that, the 4% was built in as a mechanism to provide some funding to be able to, as Cliff alluded to, looking at those positions that, as we do this compensation study, that need to be adjusted appropriately to get them closer to market. So again, I understand where you're getting at, Director Chatton. It just, there's a lot of variables here, so we're not able to pin down an exact COLA per se.
Dr. Novello.
Yes, just to build on that, I think it would help our residents and us to understand how what the range is going to be for that you're considering for some of the compensation changes. If I can put a finer point on it, will everybody be up for a 4% raise? And what do you expect at this point in terms of the range? And is everyone going to be qualified for a 4% raise? I know the answer.
Yes, no, they're not every employee is going to be qualified for a 4% raise. And again, there's several factors that come into play here. Again, as Cliff mentioned, we have the minimum wage. We have we want to provide some sort of increase based on the fact that the cost of living has increased. We want to provide the ability to compensate those high-performing employees. And then we also want to be compliant with the directive through the strategic plan to conduct a wage analysis and compensation study and make adjustments to those positions that are drastically underfunded, which there are several at this point. So there's a lot of, I just named off a whole myriad of things that are going to influence that as we get closer and start looking at all those different areas will determine what those numbers come out to be. But the short answer is no, not every employee will receive a 4% raise.
And thank you for having the courtesy to answer. It's not for us to decide, and it's also something that you've stated many times. I just really wanted to get you to state that out loud so that we can answer our fellow golfers and bowlers and what have you. Thank you.
Happy to do it.
Director Pieskoski.
Okay, Cliff, my husband asked me this, so I'm going to ask you because I couldn't answer it. He was looking at the rec news, and under capital budget, we have administration, and in actual 23-24, it was 631,000 basically. Projected for this budget is 611. Next budget is $1 million. Can you tell me what that's for, and is that the merit raise, or, I said to my husband, I got nothing.
If you're referencing a capital budget, that's for capital improvements.
Under administration?
Yeah, so there's, was there like 4 buckets there for the divisions? Admin, golf, sports
Yes,
pavilion.
it's recreation,
Yeah.
golf,
Yeah,
sports.
that's just the
pavilion.
that's just the CapEx budget for what projects are in those different divisions for the capital budget.
But he wanted to know what operations was. He knows what recreation is, golf is, and sports pavilion. He just doesn't understand what operation, administration is. What would that be?
Again, if you're referencing capital improvement, it has to do with capital projects. Administration would be, the admin department is facilities maintenance, HR, finance, IT.
Okay, so we wrap all those other departments
Yes.
into that. Okay,
Yes,
Perfect.
that's the admin division, yes.
okay, thank you.
You're welcome.
Okay, any other, okay, Director Novello.
Just to assure, or to repeat to the governing board, the Budget and Finance Committee reviewed the operating budget, and in our April 15th meeting, we reached unanimous consensus to forward this to the governing board as is. We reviewed that one change that Cliff just described at our meeting on the 6th, just this past Tuesday, and reaffirmed that recommendation to you, just so that you're aware. The committee spent a long time questioning every detail, and are satisfied with the responses that we received. Thanks.
Thank you. Any other discussion from the board on this agenda item? Anything from the audience? Anything online?
Nothing online.
Okay, then we will move on to, thank you, Cliff. We will move on to agenda item 3.04, and that is a reminder that the fiscal year 25-26 committee application deadline is May 15th. So there is the opportunity for members to go out to our website and fill out an application to be considered to be on a committee. So we encourage you to do that. With that, I will go to section 4, board director comments. I'll start with Director Horvath.
Thank you. Well, definitely pleased to hear that CapTrust presentation, also Mickey's. I'm glad that we're going to be a little more aggressive with our investments. Yeah. Yeah, so that's good. Yeah, it's like I said, it's nice that we're considering as a board to be a little bit more, I hate the word transparent because it comes up so often, but it is, be more transparent with what we're doing so that people don't have to question what we do in the independent every other week. And so I'm very glad to hear what's happening on that front. So with that, thank you.
Thank you. Director Grom?
No, sir, nothing to add.
Okay, Director Novello?
I think all our standing committees and our special committees deserve a huge appreciation from all of us as residents and all of us as a board. They all invest a lot of time and effort and so forth. So thanks to all of them. Of course, as the chair of Budget and Finance, I'm especially close to that committee, and I really do appreciate the time and the effort that the board spent in reviewing all of this material for a potential change in our investment policy. But really want to thank the entire committee, especially Mickey and Rick, for the hundreds and hundreds of hours that they spent on analyzing this and really taking to heart this charge of stewardship. So my thanks to you especially, and again, to all of our committees, all of whom are equal, and they all work very, very hard. Thanks.
Thank you. Director Chatton?
Yes, excuse me, I would, since I will be attending our June meeting by Zoom, I would like to take this opportunity to just say thank you to Directors Leary, Rhodes, and Hurley, and just say thank you for your service over the last years, and I have appreciated serving with you, and I've learned a lot, so good luck to you in the future.
Thank you. Director Piaskowski.
I'm gonna just, I don't know if this is the time to ask this question. I'm quite sure I was a spectator. Do we know what's going on with the Clay Club and Fuse Glass? Do we know what we're doing there?
It was turned over to operations, and so the answer, as I recall, was yes, clay and glass deserve more space. However, since there is no space to give,
Okay.
it's deferred.
Okay,
Is that
that's
fair?
Yeah, I just didn't know what was going on.
I would say that we found that glass and clay both need more room, and that where that expansion will come was turned over to operations with the caveat that we need to find new place for the photography club.
Thank you for that clarification. Anything else, Director Piaskowski? Okay, Director Williams?
Yes, I'd like to take this opportunity to thank the great people that I had working on the Properties Committee with this year. I had the best team. We're so good, we canceled next month's meeting because we've got it all done. But it's been a pleasure to work with all of them, and I am assuring you that the new director who will be taking over properties is going to inherit some very good people who are interested in returning. So I may have made your job much easier. But
thank you.
Thank you.
Thank you, Director Rhodes.
No comment, thank you.
Director Hurley.
Yes, I would just like to wish Director Jolene a happy birthday, and thanks for the pencils.
I gave him an unhappy birthday present.
Yeah, the only comment I'll make is I want to point out what happened here today. This change to FY12 was a large effort, and it was spearheaded, and the heavy lifting was done by our residents, you know, Mickey and Rick. And that's the way things should work. You know, it's true with all of our committees. So the system works, and I'm pleased to be a part of that. So that's my comment. Any comments? Let's see, I guess I'll go to the General Manager.
Nothing to add, President. Thank you, though.
Okay, any comments from the audience? Please come up and register your name and rec card number, and please state that as you speak.
Gary Bosak, 102-585. In a few days, I get to trade 102 degrees for 72 degrees, so I'm going to get out of here a little bit early, so I wouldn't have had the opportunity to say what I want to say. I want to make a couple comments. John kind of upstaged me with my congratulations to Jack and Nick, Tim and Dick. And I would only add that what you went through last year, you could have easily packed it in. You could have packed it in physically, mentally. You could have, some lesser people might have even resigned, but you didn't. You wound up contributing. You kept your head high. You made your points, and you did a great job. And for that, the community owes you a debt of gratitude. Secondly, there's been a couple insinuations lately in unfortunate media around here that the general manager maybe wasn't qualified having this job because coming from Wickenburg, he was going from the minors to the big leagues, I guess was the insinuation. And also the fact that he was maybe a job hopper. So I think it's important everybody understands how and why he got to where he is. Kay and I were fortunate enough to be asked to serve on the search committee last year, and Jack did too until he became president. And it was a great experience. We had over 90 applicants. And I would say to you that we read every word of every resume and threw a number very quickly in the trash because people were so unqualified and wouldn't fit our needs. But we eventually ferreted it down to the final 10 through lots and lots of meetings and conversations. We had Zoom calls with all 10 of those interviews. And I'm not sure at the time, Stephen, if you can remember, each of us had a question that we asked, and it was all staged so that all 10 candidates got the same questions. We heard the same responses. I don't know if you remember my question to you, but it was, we have what we call a vocal minority in this community, and the silent majority somehow manages to not get involved in the community. How will you deal with that? And you gave us a very prescriptive response, and everybody kind of did the same thing. But I would say from what we've seen from you so far, you've lived with what you said. Everybody can make a contribution, even when they're off base. It doesn't hurt any to hear the conversation because you gives you a chance to educate people. So just to educate some about your background, you spent 13 years in the Glendale organization. And all of these, you're a senior executive with P&L responsibilities, so there's no question about what your responsibilities were. 250,000 people, 1,900 employees, $1.2 billion budget. Then you spent 5 years in Avondale, 88,000 residents, $390 million budget. Then you moved to Chandler, and you spent 6 years there, $268,000 residents, $1.2 billion budget. Then you went to Wickenburg, $76 million budget and 8,000 residents. But what people don't understand is you weren't part of Maricopa County's responsibility. So everything that we get from Maricopa County here, you had to deal with. So roads and cops and medical and all that sort of thing was your responsibility. So for anybody to think that you have not done your work and aren't qualified for this job, you should figure out what you did before, like we had the opportunity to do. And I would say coming in to the final interviews, you were very, very unanimous in all of our 9 opinions. And we had high expectations, but in the first 9 months, you've exceeded them. Thanks.
Thank you, Gary. I really appreciate the comments, and it's been a great experience so far, and I've enjoyed every bit of it, and I'm looking forward to a long tenure here, so thank you for that.
Thank you. Any other questions or comments? Anything from online? Okay, then with that, our next workshop is June 13th, 2025 in this lecture hall at 9 a.m. And the next governing board regular meeting is May 22nd, 2025, 9 a.m. in the lecture hall. And with that, I will adjourn the meeting at 11:02.